again. My name is Stephen Davis. I'm with the Community Investment Collaborative. I'm going to kick us off, and then I'll probably fade to the background for the rest of this one. CIC and the Central Virginia Small Business Development Center, in conjunction with First Citizens Bank, are excited to host part 2 of this workshop, focusing on financing your business. We're glad to have you here today. I'm sure we'll have a few more join, but with the small group, as Rebecca mentioned, we'll work to kind of incorporate your questions or the things you're most thinking about into our conversation. The quick introductions, we have Brian and April. Do you want to introduce yourself and First Citizens Bank? Just the quick intro.
Sure. Brian Thomas, commercial banker here at First Citizens. I've been in banking since 1981, and all that time since '83 in commercial lending. And First Citizens, for some people that don't know it, is headquartered in Raleigh, North Carolina, a $39 billion, largely family-controlled bank, and it is the largest family-controlled bank in the United States at the present time. And one of the things we'll touch on is that First Citizens does participate with the Small Business Lending Administration, and we are a preferred lender, and we may discuss that later. I'll let April introduce herself.
Hi, I'm April. I'm in financial services here. I've been with First Citizens for 10 years and banking for over 14. I definitely like to help out small business owners kind of build their business, look at different needs, and really develop that relationship. So thank you for everybody for being on the call today.
Thank you both, and thanks to First Citizens for helping us host this. So I'll now turn it over to Rebecca Haydock, who's the director for our Central Virginia Small Business Development Center, and let her introduce herself and then take it from there.
Okay, thanks, Stephen. So everyone, good afternoon, and we're happy to provide this program today. It's the second part of a commercial banking series. Last week we talked about developing a relationship with the bank and how valuable that is, how to get started, and some of the things to consider. And today we wanted to take it the next step and really talk about business capital loans and moving forward with your bank. So when you do need that capital from a bank, that you are prepared and you're aware of some of the considerations. But before we do that, and I'm going to hand this off to Brian and April to talk, I just wanted to give a brief overview of some of the different forms of capital that are considered in the early stages of a business. I thought this was a good illustration to talk about the fact that as businesses grow, there's often different forms of capital that are available for different stages of the business. And businesses don't tend to grow in that straight up line, right? You have a certain level of resources, and then you can optimize your revenues and what your business can do at a certain level of resources. And then you need more money to go to the next level, and then you optimize there. And, an old statement from, years ago in banking was, if you get stuck between those levels, you can be in trouble. So thinking about capital ahead of time before you go through a growth step is a really great idea, and having a good bank relationship to help you through that helps as well. And, I didn't mention either, this Small Business Development Center, we are supported by the SBA, by community partners like Community Investment Collaborative, by the banks and others, and we are here as well to help you try to figure out these steps and these sources of capital. But some other options I'll go over very briefly are, often early stage businesses start with friends and family money. Money you've saved yourself, maybe a family member that believes in your vision and will help. And that can often take the form of a loan that would be repaid. Sometimes it's equity in the business where they would like to actually own a piece of the business. And also crowdfunding is considered, part of the Friends network these days, where people may pre-order or may fund your business based on a crowdfunding source. There's also cash flow tactics that people are really starting to pay attention to. There are lots of different ways that you can free up capital in your business to survive longer, to pay your employees, and those include things like having your receivables paid sooner. So working with other businesses or customers that owe you money for your goods and services, actually shortening the term by which you collect that money. Also possibly getting some payment in advance for expensive items or expensive goods. Your accounts payable, you may be able to negotiate terms with your suppliers to get another 30 or 60 days before you have to pay your bills. And that frees up a great deal of cash flow. And there are many other cash flow tactics that you can consider to give yourself a longer runway and greater cash in the business. There are, of course, grants. Those are typically for businesses that are doing research and development, are technology-based, or operate in a target area for a grant provider. They are often based on a specific type of business or a specific location that is of interest to a grant provider. But those are something that if you think your business might be eligible, that are good to look into. Of course, there's early stage equity capital, which is capital for a percentage of ownership in your business. These are designed for companies that are set up to achieve significant growth, because both angel investors and venture capital firms will typically look for a company where whatever they put in, when it's time to get that money out, they're making 5 or 10 times their original investment. So they really look for growth companies with a solid platform for growth. Strategic alliances are another area of capital that are often overlooked. If you could benefit from someone else's sales team, someone else's distribution channels, something that another business, maybe a broker or a distributor, those types of strategic alliances can move your company forward and reduce your capital outlay. There are so many forms of strategic alliances as well. Sometimes, beta trials or research programs or other agreements where you're doing work for another company and they're paying you in advance to do that, consulting contracts. So strategic alliances are something else to think about from a financial perspective. And then loans and lines of credit. Again, building a solid credit foundation for your business is really important to being able to scale. And there are a wide range of credit opportunities, which Brian will go over with you. Today, Brian is going to talk to you about commercial banking as a lifelong business partnership. He will talk to you about business capital versus personal capital, why credit does help your business, and getting the debt capital that works for you. Brian, would you like me to take this screen off so you can see and talk to everyone and stop screen sharing, and then we can come back to just wrap up the end, or what would you like?
We can probably use this if everybody can see this as well as myself. Does everyone see that? I guess that means a yes.
You all are
Rebecca,
welcome to take yourselves off mute if you like.
Please, because we wanted to go through this 2 ways. One, to give you sort of a high-level view, but then talk and share thoughts and look at some questions as we did in the previous one also. But Rebecca, I think you did a great job enlightening people to capital and how it can be obtained and how important it is. When banks are looking to lend money, we're looking to see what individuals have in capital to put in themselves also. And if you think about capital, it's also considered equity. And as you look at a balance sheet, the equity section is going to be on that right-hand side of that balance sheet, because you'll have assets, liabilities, and your equity if you've looked at a balance sheet. And the equity is going to support the amount of debt that you can carry. So if you think about it from that standpoint, the equity plus the liabilities is going to equal all the assets. The initial phase of funding, like Rebecca talked about, can be numerous different ways. It can be equity from yourself. It can be family equity. It can be grants. It can be loans. In a lot of cases, if there are loans for that equity capital, the bank may request that you subordinate or pay the bank first before you pay back that other equity. So those are some of the sort of the things to talk about. Last week, we touched on relationship banking and how important it is to have those initial but ongoing considerations and conversations with your banker. Because as you start the business, that first portion of loan funding that you may need will probably grow into something else. So having a continual conversation with your banker about structure and those types of things is going to be real key. As we talked about too, you should be enlisting the advice of your CPA if you have one, also your attorney, and your banker as a trusted advisor. So you really should have a three-party discussion there as you're looking at these types of things. One of the things the SBDC can do, as Rebecca was talking about, help with the business plans, the projections and things like that, but then also help you to that next phase as you need to grow. Talk a little bit about personal capital. Personal capital, and again, touching base on credit and how important that is to your business, but also to your personal side. Some people may remember the 5 C's of credit. I hope some people have. It's one that's talked about a lot, and the banks will look at it because that's going to show the ability of both the individual and the business to carry on and to satisfy debt payments. Number one is going to be character. What is the character of the individual that is borrowing or the business? One way that you can show positive character is by handling your own personal credit in a good way. That can be your credit cards, that may be an auto loan, that may be your mortgage. Those are things that the bank is going to look at, and it's very important. Another one of those is the capacity. Capacity is how much capital you have or your business has to grow that business. So as you're not borrowing all the funds, they're going to look at your capacity. Collateral, we talked a little bit about that. That's what's going to secure the loan that you're going to take out. And we'll talk a little bit deeper about that too when we get into specifics about types of loans. The conditions. Conditions are real important as the bank looks from time to time. We know the conditions right now have been challenging. If you look back into January and then COVID comes along, the conditions have changed a lot at how we're looking at lots of things. Retail real estate, just the business cash flow, those things are very important. And the next one is the capital that you have to put into the business too, which goes back right to personal capital, and capacity are somewhat the same. So those are sort of real key. I'm sorry my phone's ringing. Please forgive me, folks. It'll stop. But thinking about that and talking with a relationship banker or someone else is going to be the real key to how you look at that. Business capital and personal capital a lot of times are the same, because in most cases, the small businesses we're talking about, you're going to own most of that. You're probably not going to be out in the capital markets. So we're going to look through that business to you all also and see what your personal capital is, as well as the business capital. You may hear the phrase global cash flow. And what global cash flow is, we're going to take the business debt service, the personal debt service, because in most cases you'll be requested to be a party to that, either as a guarantor or co-maker, and that cash flow is going to show your ability to cover all debt service. Why credit helps your business? That's a real key. As you start credit and build that, a lot of that information goes across and is reported. So that's one of the things that you'll find that is going to be reported to reporting agencies out there that a bank or somebody is going to look at along the way and say how they handled it. Lots of times, accounts payable people in companies will look at that and say, what is the credit history of this bank before I can extend credit to them too? What's the credit? And that's real key to manage that appropriately. Managing the amount of debt to the amount of capital is real key. Getting the debt capital that works for you. Stepping back, one of the things that to really think about are all the different types of loans that are available. The real key probably is to match that loan to what your real need is. The truth there is, if it's a short-term need, it should be a short-term loan. If it's a long-term need, it should be a long-term loan. When you start to look at that, that's where you can ask and find the correct way to structure those loan proceeds, because over time is how you're going to pay those back. Let's take, for instance, a line of credit. A line of credit typically is revolving. What that means is it goes up and down as your assets go up and down. So for instance, say Brian has his own business and I'm selling to Rebecca on credit. That is a receivable. If I sell something to Rebecca, I am going to issue a receivable. She's going to pay me back at some time. That line of credit can support that short-term need until Rebecca pays me back. If I have inventory and I have to buy my inventory and I am selling it, part of that to Rebecca also, so that's going to go off my balance sheet, I've got to support that because I've paid cash for that. Now, one of the real keys, and I think Rebecca was looking at this, is managing credit is real key in your cash business. And you can do a cash flow analysis that gives you the breakdown of that. So it's real key to sort of understand how that balance sheet works with your cash, and you make the right type of loan meet the right type of need. For instance, again, let's go back to purchasing a vehicle or a piece of equipment for your business. That piece of equipment or vehicle is going to have a lifespan, probably more than 1 year. Let's take, for instance, if you have to have a pickup truck, that might have a lifespan of 4 to 7 to 10 years. You want to match that lifespan with your loan. You don't want to pay it off short term. You wouldn't want a 12-month loan if it's going to last 4 years, 5 years, 6 years, because you're going to need to have earnings and show the earnings to pay that back over a period of time. Therefore, too, when working with your advisor, whether it be a CPA or whoever it might be, is matching your depreciation schedule, which is known as a non-cash expense, to your debt payment. So purchasing an asset that has a value and a lifespan, usually in excess of 12 months, you want to put that on what we would call a term loan or installment. In a lot of cases, on the personal side, they will be called installment loans, whereas on a bank side, it may be called a term loan. So those are a couple of things. When you're looking at, for instance, a building, and you're needing to purchase a building, there are different ways to look at that too, and you're going to amortize that over that lifespan that building may be worth it to you. And in that aspect, typically buildings will be financed 15, 20, 25 years, because that is the lifespan that you will look at for that. Thinking about it from that standpoint, there are lots of different ways to do that. One is a 504 loan through the SBA, and I'll bring up the SBA because there you can put 10% in. The bank will lend you 50%, and the CDC will lend you 40%. So you get 100% of your financing with only 10% capital in. The SBA also has the 7A program, which is outside the typical bank scenario. And the 7A program, if you were to go to the SBA website, can give you great insight into what that can be used for. It can be used for working capital, long-term, asset purchases, things of that sort. So that is a real key for a small growing business if it needs to look at the collateral situation, but it has cash flow, but maybe there's not a collateral situation that enables you to get that loan. The SBA is one of the ways that we look at helping people to do that, because that will sort of back end our collateral that you may not have. And again, looking at that too, looking through the personal side is going to be one of the real keys. And I will enlighten you that with an SBA loan, if you own 20% or more of the business, you are going to be requested to be on that loan as a guarantor or co-maker, and you may have to pledge some of the assets too. So those are some of the things that I wanted to share with you there. The short-term credit needs of a business also can be met with what we call as business Visa cards. And a lot of people will do this. And it's a great way to handle it because the terms usually are pretty good. The interest rates have been very attractive lately. Some are even often 0% for that period of time too on business credit cards. So that is an avenue that you want to look at, but please manage it accordingly. Don't go out there, run it all the way up and just pay that minimum payment, because that interest is going to accrue on you where it's going to be very hard to do that. And that's where building that relationship with someone that's going to offer you that advice to meet the needs of that is going to be real key. And stressing credit both personal and business, as Rebecca touched on earlier, is really important, folks, because that's going to be the constant that's going to follow you. If you've been able to maintain good credit personally and in the business, it's going to be a whole lot easier to address that next need that you may have. So I can't stress enough of that. Managing your balance sheet. I know we're talking about capital, but remember, capital or your equity is part of that balance sheet. So managing that is going to be real key for you in relation to the amount of debt and the assets that you have. Now, again, for some of you, I'm not going to get into an accounting method here, but you have cash, receivables, inventory, and all those things, and equipment on that left side are the assets. But managing that against what you have in debt against it is real key. Managing that debt to worth ratio, as we call it, is real key when the bank is looking to lend you either short-term or long-term money. So I wanted to do that this way and show and talk about it in a big picture about some of the facilities that are available. You've got business credit cards, which are, I would consider short-term. You got lines of credit, which are short-term. You got term loans or installment loans to pay for those assets that may have a lifespan greater than a year. And you've got the longer-term loans, building loans. One of the things that a term loan can do too, as businesses grow, there are times when you're growing so quickly that some of that short term needs to be financed long term. And that will happen. Numerous times that has happened where businesses continue to grow. You've got equity in there, but the only way to repay that is through those net profits that you receive over time. So managing that income statement and balance sheet together are going to be real key. And one of the slides, if I can go back, which slide was it, Rebecca? Cash flow tactics. That's a great slide to bring back up if you can. There we go. Rebecca's straight right on there. If you think of a cash flow statement, and just for a minute, an accounts payable. If you have an account payable, that means you owe somebody at some time, right? But that's cash that you may have in your business because you got essentially a loan from them, and that is payable at some time. A receivable is going to be a use of your cash because, again, if I go back and I sell something to Rebecca, I've taken something probably out of my inventory. It's cost me money already, and Rebecca's going to owe me later. So that's going to be a use of cash. Supplier terms, that's one of the keys that you can really think about in cash flow is what term can I get to pay back what I've borrowed, essentially from someone through an account payable. So those are sort of the real keys. I've put that out there because understanding how that income statement and balance sheet work together is real key in cash flow tactics. Capital, of course, is going to be equity that's injected into your business to help you pay for those expenses, whether it be purchases and or just the receivables, inventory, and things like that that you're going to need to flow through. So when you're thinking of loans, lines of credit, credit cards, the first thing probably to really think about is, what is my need for that money? Is it short term? If you can match it short term, do it. Is it a long-term asset? Let's finance it long term. Let's make sure that we have that discussion about the asset that you're purchasing and the need, because one of the keys that I can see and I've seen in my career is when businesses get upside down, a lot of times they're not matching that asset to the loan or the amount of equity that's needed. So I hope that's helpful in thinking about that. The keys, again, are thinking about talking to your banker or a banker just to sort of think through what are those needs that I'm going to face now and in the future, okay? Those are some of the things that are real key, and I know Rebecca and Stephen talk about that with the SBDC and CIC also as how important that is. So I guess we should probably open up, Rebecca, for some other things as people may have questions. I hope that's helpful.
That's fantastic. Thank you so much. And there is a question already in the chat box. If you couldn't get the supplier terms you want, would you ever use your credit card to improve the time frame in which you might pay it back?
I would suggest yes. Because, for instance, say you can only get 30-day terms from a supplier, but you have an asset or inventory that's going to take a little bit longer to sell and get repaid back, you could probably get better time frame using that credit card. I can tell you, I know numerous businesses that have started on credit cards and then have evolved into term loans and or lines of credit. Again, though, be careful. Be careful. Make sure that you're not overdoing it. Make sure that you can manage that through. And again, remember that interest rate may be a little higher than a term on a supplier. You know, a supplier may offer you, let's call it net 10. If you pay me in 10 days, you don't pay anything. But then after that, they may start charging you something. So managing that is going to be real key. We go back to business credit. Business credit, there are creditors out there that will report on the systems as to how you have been paying too, okay? So managing that business credit, as Rebecca put up earlier, is really important, because if you start going past due on business credit, that will be reported to the reporting agencies, and that's typically through Dun & Bradstreet. Dun & Bradstreet is the company that accumulates that information and will then share it with banks and other businesses over time that you've been current on your debts, your 30 days, your 60 days. So just manage through that. So you can get better terms in some cases in those places. So I hope that's helpful to answer that way.
Any other questions?
Do I need to drive deeper into the types of loans for people anymore? If I do, I can certainly do that.
Feel free to go ahead and unmute yourselves.
Oh, thank you.
There you go.
My dog was barking, so I kept muting myself.
Oh, yeah.
So definitely, like our biggest thing is we're within our first year of business, and now we've hit all of these complications with COVID. So
Yes.
we're not really set up that well with we have like no business credit yet because we hadn't really qualified for anything and really needed it yet. So can you advise us just a little bit on like new businesses and in this current environment, some of the directions that maybe would be available to us or that we might want to go in?
I can. And I think that it's either through the chamber or Rebecca, you may have sent this to, or Stephen. There are some grants out there available right now in certain areas. I know the city of Charlottesville, Albemarle, Green have some that are available to small businesses that have been affected by COVID. And you can apply for grants. And I've seen a lot of areas start to build those. So that's one avenue, and those are grants. I have not seen any loan terms tied into those, but that's one avenue.
And those are,
avenue, I'm sorry.
Sorry, just to let you know, those are all listed on our website, which is CVSBDC, which is, I know, a mouthful, but it's Central Virginia Small Business Development Center.org. And there's a COVID-19 page. There's also an access to capital page, which goes into more detail about, what we talked about today, but there's a link to local grants and all of the community grants that are Virginia or local municipalities are listed there.
I think there are an awful lot of avenues out there to sort of help through this process. And like Rebecca said, going to the website and or just talking with people out there is one of the ways too that you can get some advice. So hopefully that's helpful.
Yeah, and of course we encourage you to give us a call and we can, look at your specific business and try to figure out what's the best source of capital for you.
I think that's real key for everyone on this. Rebecca can give you some of that leading edge thought process to how to manage through this. And they have lots of different avenues available to share that, with projections, where you are now, projections, things like that. So please make that source useful for yourself, because that's why they're there. And that's why we, the banks and SBA help fund the small business development centers. It's for that very reason. Okay. Okay. Good. Do I need to drill any deeper down into the types of loans for people? I wanted to sort of hit those short-term, medium-term, long-term loans, and then some of the capabilities within them for everyone to just sort of think about as to matching asset needs to liabilities, and then the portion of equity.
I think that would be helpful.
Okay. Again, just thinking back, short-term loans, are those loans that, maybe a line of credit, maybe a 90-day note, but typically you're going to finance your receivables and your inventory there if you're going to have that within a 90 to 12-month period, okay? Looking back again at equipment purchases, that may be something that you want to think about. 12 months, 36 months, 48, 60 months typically are what banks are going to look at. We have done numerous loans, 7 years on equipment and things like that. But I think the real key there is, again, matching the need and the asset to the loan repayment term. when you're talking about, let's just say leasehold improvements. Leasehold improvements are one of the hardest things to finance. And typically, that will be matched to your lease term. Say you've got a 3-year lease term, it would be matched in that 3-year period of time, because at the end of that lease, we don't know where you might be. And that's where realistically, again, you may have to blend some additional outside collateral with that. You may hear from a landlord or a bank, a landlord lien waiver. And basically what that means is the bank could have lien waiver over that landlord if you were to default. So that's something that a lot of people will hear about, and it's something that, just to educate you on, may be requested if you're getting bank funding and you've got a lease on your property. But if you're looking and are in that process of buying a building, there are lots of different ways we do it. We do 5, 7, 10-year terms. We'll do a 15-year up to 20, 25 years. And then you've got the Small Business Administration with the 504 loan, which is a great loan. I've done multitudes of those, even from construction on up, where 10 to 15% of your equity, and you can finance the remainder. And typically the CDC portion of that is a 20-year loan with a 10-year fixed rate. And the bank typically matches either a 5 or 10-year fixed rate there. And the rates have been very good there, I will tell you right now. So as you think that next phase with a building or something like that, there are lots of avenues to go that route. Typically 15 to 20% for a typical bank loan on a building is pretty typical. But then the SBA, you can jump in with the 10 in most cases, unless it's a special use property, and that's where you get to 15. So those are sort of real keys. And again, going back to the question about the credit cards, that is a good way to manage that, especially for short-term needs. But again, making sure that you don't get caught and you can't pay it back and you're just paying the minimum payment and you're accruing interest. Again, that's a way to do some short-term. Okay? Does that help you?
Yes,
Brian,
that's
can
very
you-
useful.
Can
Yes,
you talk
Rebecca.
a little bit about when you can move from one stage to another? So for example, if your business is brand new and you haven't established any business credit, so you are starting with a credit card,
Yeah.
What would an entrepreneur sort of look for to know that it's the right time and a good time to talk to the bank about switching to a different form of capital that may be less expensive for them?
That's a good question, Rebecca. And I'll look back to this sheet, which you put up. I think that was your first one. So, if we think about the stair steps, and typically, that's going to be probably 1 to 2 years to try to move that from some form of debt to a bank debt, to be honest with you. We're probably want to see 1 to 2 years of business financials and strength to be able to then convert maybe something that you've got on a short-term or business credit card or equity in the company to a longer-term loan or a bank line of credit. So we're going to want to see some type of history, and typically 1.5 to 2 years is best along those cases. So I hope that's helpful.
Having a lot of trouble with the screen share. Can you all see that now?
That's okay, but you can
Okay.
see the seed, which is your equity going in, or someone else's startup growth. That growth, and you get established. That establishment typically is 1.5, 2 years. And if you're expanding in that period of time, that's where you really want to start having some discussions with that bank. Rebecca, does that help?
Yeah. Another question I thought might be helpful is credit score, and moving from your personal credit score and personal guarantees to the business being able to support the debt or whatever forms of bank capital you're pursuing.
That's a good question. And I'll just tell you what you will find in a lot of cases is that credit score in the 600s. 650 may be the minimum that you really need for certain types of bank loans that you can get. But the 650, 700, again, managing your personal credit with your business credit is going to be real key. There are scoring of business debts out there now, and that's one of the things that is important to note, is that banks do report, as well as some of the creditors, like we talked about, to Dun & Bradstreet, will be pulling that information down, and you will have a business credit score as well as a personal credit score these days. So a lot of the things we look at, again, are going to come back to the personal credit score, how you've managed that personal credit, then what is your business score, if we're able to get that, and how important those are together, okay? So I can't stress as much, and I know going back to the CIC class that I had taught many years ago, was credit and credit score was just real important. And I hate to see people get tripped up when they do apply and their personal credit has been challenged. We have to look back at that, because in a lot of cases, we're going to look back to you. If you own 20% or more of that business, we're going to look back to you for some type of co-maker, yourself, or a guarantee in a lot of cases like that. The question also may be, when can I move away from that credit on the business loan? And that's a hard one to talk about unless you own less than 20% of the business and there are other equity injections in there and you've got additional collateral. So that is one of those hard questions that's always asked, is when can I personally be removed from that? In a lot of cases, that's not a real world situation when you own 20% or more of a business and it is a small business, to be real truthful with you. Okay? So I hope that's helpful. But I think this seed, startup, growth, established, expansion, if you think about that bank debt in that between the growth and established, is probably the real key, and then the expansion. Expansion is when you probably need some capital to expand the business above what equity or strength you may have in there. Okay? Does that help, Rebecca?
Yeah, I thought that was great.
Did I not
Thank
answer
you.
that question?
No, that was fantastic.
You're welcome to reach out to me just to ask about, this what type of loan, these types of things too. I think my email address was added. So you're welcome to reach out. Okay, folks?